I think we're going to get started. We have a fair amount of content to cover today. So the very practical problem that we're going to, this chapter, among others, is going to address is stated on the first slide there. The case that you will be doing 2 weeks today is a case where you will help Pacific Healthcare decide whether they should refund their bonds at all, whether they should refund their bonds today, or whether they should refund their bond a year from today. So there's three very distinct choices, and you as management teams will face these kinds of choices when you deal with your debt in the future. So I claim that debt financing is probably one of the most important topics we're going to take. So why do I say that? Just wishful thinking by a university professor that what I'm teaching actually matters. Why do I say that? Debt financing is important.
Does we need to understand where our capital comes from?
Yes. Healthcare organizations are very big users of capital. The other reason as well is that almost all healthcare organizations will use debt at some point in their lifespan. Versus investor-owned, when we talk about equity financing 3 weeks from now, that's very important for investor-owned organizations, but debt financing affects everybody. Right down to a mom and pa physician solo practice. Almost certainly at some point they will have debt as well. Debt financing is really pervasive in the healthcare system. The first place I'm going to let you read all the institutional detail about bonds in Chapter 5, but I do like to mention bond ratings because bond ratings are very important. What are bond ratings? There's a nice little table there with all kinds of letters from the alphabet. What do they mean?
How risky it is to purchase a bond from you.
Right, so these are independent agencies that have no financial interest in the bonds of corporations or not-for-profits that issue debt. They go in and they make a judgment about the probability that this organization will be able to repay the debt which is borrowed from investors. So these different letters that you'll see here, A's, generally speaking, are investment grade, meaning that there is what kind of probability of default? Not zero. Low, very low. So Moody's, S&P, Fitch, the AA, AAA, that's all good news for investors. So they will, why is that important? What impact will that have?
It will allow that company to have access to lower interest rate.
That's right. There's 2 points what I just said. One, it will make it easier for the healthcare organization to issue debt if it's got a high rating. And secondly, it will allow them to pay a lower interest rate. Those are two different things. So bond rating companies, all three of these, took a really big hit in their credibility after the recession of 2008-9 because they said, all those investment banks are all great. It turned out a lot of them were not great. So they've done, in fact, a lot of rework over the since the recession to improve their methods, their transparency, and the way they make judgments about the financial condition and performance of particular organizations. What is absolutely clear, however, today and as it has always been, is that these bond ratings are very important. CFOs lose sleep worrying about bond ratings. And the reason they do is because of the issues that we just talked about, their ability to raise capital, the interest rates they will pay. It's also a signal to the community and the investor community and the public as well, is when you have a downgrade, what does that say?
You all know how to manage your money.
Well, that would be the extreme interpretation. But it's certainly not good, is it? It's a sign that either management is not doing what it should be doing, or the payer mix has changed in a way that makes it adversely effective to the organization, or the town's population is declining and the hospital's going down with it. I mean, if there's not a lot of good news and a rating downgrade. So these are very important issues. How do they do it? Well, they go in and they look at everything. Many people think that all the bond A rating agencies look at are their financial statements, and that is far from the truth. That's probably 5% of the documents they look at are financial documents. They will look at your medical staff mix. They'll look at your market area. They will look at your staffing size. They'll look at productivity, efficiency indicators. They'll look at the support of the board. They'll look at history. They'll look at the relationships with the government. They'll look at your track record, your credit history. There are many, many different things. And probably most important, they will look at the quality of the management. Does the management really know what it's doing? Will the management be able to repay this debt over the next 15, 20, 25 years? And just think about that for a second. When you will, one or more of you will be on a management team that arranges for a large sum of money to be borrowed. What are you doing when you sign your name on that dotted line? Sorry?
Promising to pay it back.
You are committing your organization to 20, 25, 30 years of debt payments. Hands up everybody who's going to be in the same organization for 30 years. Probably no one in this room. But you will be committing all the managers who follow after you to making those payments. So it's a big deal. Large bond issues, small bond issues are a big deal from a management perspective. They are committing the organization in a substantial way for long periods of time. Interest rate component. So again, this is in my policy of trying to disclose how much of this, what I'm talking about today, will you see in the real world. I would say almost all of it, except for perhaps this simplistic equation. This is a way of characterizing what goes into interest rates. You will not see anybody solving this equation. But almost everything else we're going to talk about today, you will see in the real world. So what this is saying essentially is that interest rates include many different components. So the real risk-free rate, what is that? Does anyone from their economics courses and undergraduate what the difference between real and nominal is?
One's adjusted for inflation.
Right, so a real risk-free rate is essentially what would be the rate of interest that would be paid if inflation was zero. So if there's no inflation in the economy at all, how much would I demand as an investor to part with my money? So that's sort of the minimum wage of debt payments. It's the minimum interest rate that I would demand in a zero inflation economy. Then there's an inflation premium. As we talked about a couple of weeks ago, investors are not naive. They know that if prices are changing 1% per year, then I have to have that 1% per year built into my return, or else I, in fact, will have a negative return. So we build in our expectation of inflation. Again, that is an expectation. It's what we think inflation is going to be over the life of the bond. What's a default risk premium? Sorry.
It's like it's just like the inflation premium. It's something you put in case of, to account for the chance that bond or whatever you're doing would default.
Exactly. So what would it be for the United States government?
Zero?
Probably close to zero, depending on what happens in Congress the next week or two. Historically, it's been zero. So, and what would it be for a large organization on the verge of bankruptcy? It would be pretty high. So the default risk premium essentially is what component, what part of the interest rate that's being demanded by investors is due to the default probability on this debt. What's a liquidity premium? I would like to know that.
It's if you have, you make an investment in something that is illiquid, then you get a higher premium for that.
If you make an investment in something that,
That is illiquid, you get a
do you
higher
want to tell us what you
premium.
mean by illiquid?
I'm sorry?
Can you tell us what you mean by illiquid?
It doesn't translate to cash very quickly.
Right, so if you're buying and selling bonds in General Motors or Chrysler or something like that, it's easy to pick up the phone to your broker and say, buy and sell these bonds, because they're widely traded, there's large numbers of bonds out there. So they're very liquid, they're very easy to convert into cash. If you're buying bonds in Joe's Car Wash and Emergency Department, those bonds are probably not going to be as widely disseminated. They'll be hard to unload. There are not many of them, and they're not widely disseminated. Finding a purchaser for them will be difficult. So that's what Bradley means by illiquid. What does price risk mean?
So I think it's, you pay a certain price for a bond, and then if the interest rates go up or down, your price will be affected. So then a premium is included to account for that.
Yes, okay, so we're going to talk more about that interest rate risk in a minute or two, and you're getting at the right thing. Essentially, what it means is that I, as an investor, haven't got the same attitude towards a one-year bond versus a 30-year bond. If you want me to part with my money for 30 years, then I'm going to demand a higher rate of interest than if you only want me to part with my money for 1 year. So essentially, it's a compensation for how long the bond might be held, which has implications for what you said in a minute. We'll talk more about that in a second. And then finally, call risk premium. What's a call risk premium?
It's like compensation if the bondholders call a bond in before it matures.
Exactly. So some bonds are callable. And what that means is that the management has the right to call the bond, so that if there's a big change in interest rates and management wants to call the bonds in and then issue new bonds at a lower interest rate, because they would only call the bonds if what happened to interest rates.
Go down. We go down.
Why do you say that? I mean, that's right.
Because if you're paying, let's say, an interest rate of 8% on the bonds that you issued, and then next year the interest rate goes down to 4%, you might as well pay it and issue new bonds.
Right, so what we're saying is that if you've got an existing bond that's paying 8% and then interest rates decline to 4%, then it may make sense for management to call the bonds, the 8% bonds, pay off the bondholders, and reissue new bonds at 4% because of big interest savings. So one of the case that you're going to do 2 weeks from now, that's the kind of situation you're going to evaluate. So all those sorts of premiums are built into the particular interest rate that will be levied on each different kinds of bond instrument. Every organization faces a unique interest rate on its debt because they all have different risk investor assessments of these risks. And furthermore, the interest rate on the debt for one organization will change over time. So all these are different amongst all organizations, and they all change over time. The term structure of interest rates is the relationship between the interest rates that are charged and the maturity of the bond. And as we talked about a minute ago, generally speaking, the yield curve, which is what it's called, is upward sloping. So here's what it was 3.5 years ago. The 2-year bond rate, the Treasury bond yield was 1%, 5-year was 2.4%, and so on. So let's just take a quick diversion. and see what the yield curve looks like today. It's not finding the internet. Okay. If you can see it today, this is what it would look like. It's exactly that. It is an upward sloping yield curve. It's not as steep as this is. So what does this tell you? Why is this information interesting? Why is this information paid attention to? What information does this tell you about investors?
I think that would be the lowest interest rate that they would be expecting.
Mm-hmm. So the fact that it's upward sloping, what information does that tell you about what investors think is going to happen? Yes.
Just that a bond's gonna be riskier the longer it's held.
Okay, these are treasury bonds.
Oh,
So there's probably no liquidity because treasury bonds are widely traded. There's probably no default risk because they're the U.S. government. They're not callable. So what's left?
Inflation.
Inflation. This is a useful curve because it tells you what investors think is going to happen to inflation. Have any of you ever talked to your parents about having a mortgage in the 1980s? What interest rates were your parents paying on their mortgage in the 1980s?
10 to 15%.
10, 15, 18%. Why?
That's high inflation.
It was high inflation, and investors wanted to be compensated for that. So in the late 1980s, when things began to change, what happened, do you think, to this yield curve? If I could plot the yield curve for 1989, what would it look like? As inflation started to ebb. That's right. It was downward sloping. For one of the very few times in history, we had a downward sloping yield curve. Meaning what did investors expect?
Inflation.
They were gonna go down.
They expected inflation to go down, and it did go down. Historically, though, we have an upward sloping yield curve. Through 99% of economic history, we expect inflation to be higher in the future than now. What determines interest rates? Many, many things. Federal Reserve policy. I don't know how many of you follow the actions of Ben Bernanke and the Federal Reserve. We're now into QE3, quantitative easing 3, where the federal treasury is buying bonds at $85 billion a month to get money into the market. They certainly have a huge impact on interest rates. We have historically very low rates right now. Budgetary policy, when the administration goes to the markets for, what was it, 3 years ago, $1.5 trillion in bonds, that has an effect on the demand and supply of bonds and the interest rates, and just a general level of economic activity. As things begin to boom and demand takes off, interest rates tend to start to go up because of the Fed has concerns about inflation and the vice versa when things start to go down. So there are many, many different influences on interest rates.